Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for tuning in to our latest market update and outlook video. Now there's a lot of stuff going on right now in the headlines. Geopolitical risks are very elevated right now, but the market is kind of hanging in there pretty well. So I want to explain, potentially why that's going on, and also give you a little historical perspective of what happens in the past, or what has happened in the past when there's geopolitical shocks just as this. So let's get going. All right, so March was a pretty turbulent month. We had the trifecta. We had the concerns about tariffs, the AI disruption that was still continuing on, and now private credit, which is having a little scare as well. So this is all on top of the overall geopolitical angst that's going on during the market. So as you can imagine, it was not a good month, ended up being not a great quarter year to date. Large cap was down about 4.98, almost 5%, led mostly by tech stocks, although they held up a little better in March than some of the other stocks that had been doing a little better to this point. Small cap was down 4%, so actually held up okay, relatively speaking, to large cap. It's still down quite a bit. Actually still up for the year. It's actually the better of the domestic performers for the market. Real estate took a pretty good hit in the month as well, although they are up a little bit since they had a very good February. And international, look at that. So international was leading pretty strongly going into the month, but with the concerns about oil prices hurting international more than here in the U.S., you could see how developed market stocks were down quite a bit at 11%, emerging market as well. China, India, a lot of them are very reliant on oil that comes out of the Persian Gulf. So you can see them down as well, 10%, a little bit negative for the quarter. Fixed income was down a little bit with oil prices going up. The fear of inflation starts to kind of rear its ugly head again. And so you can see U.S. fixed income was down a little bit. Rates went up a little bit. High yield kind of did the same. Although ironically not as bad as the higher quality. So that was good to see. But the big winner was commodities. It was kind of mixed though, because gold and a lot of precious metals actually were down quite a bit for the month of March. What went up a lot was energy prices, oil, natural gas, fertilizers, which is going to also include some agriculture. So it was a pretty interesting month. Let's dive into what happened and what's going on. All right, before we really dive into some of the current events, I wanted to give you a lay of the land. Here, the Big Three report. Again, this is where I show you the big leading indicators that show us how the economy is doing. So as you can see here, the ISM manufacturing report, this is, if it's over 50, that means it's growing. Previously, it was at 52.4, which is actually pretty good. It was actually one of the better numbers we've seen in several months. And it actually went up again, 52.7. So the trend is up and it's positive. So this is a very good sign. So hopefully we'll get some manufacturing growth that could help with the economy. And then we also had just this morning, I'm recording this on Monday, ISM Services PMI just came out. It came out at a 54, which is still in the green because again it's over 50. But it's a little slower than it was the previous month. But I would say the previous month, 56.8 was really, really high. That was a phenomenal number. So 54 is a little bit more of a normal growth number, but still, I would say a pretty positive number. And then the last one is the unemployment report from the BLS. And it's been kind of all over the place, so I don't know what to say about these numbers, but last month we lost 92,000 jobs and we were at 4.4%. This month was up 178,000 jobs, and unemployment ticked down to 4.3%. So this is very volatile data. I would say if you just kind of average what we've seen over the last 3 months, it's actually still pretty good. We're 80 plus thousand per month, which is actually showing up as the economy is still holding up pretty good. The numbers that we saw for layoffs and things like that were not anything that were out of this world. They were a little high, but not too high. So overall, the labor department, or the labor force, I should say, is holding up pretty good. So I would say the assessment for the economy right now is still pretty solid. All right, so the conflict with Iran is what's making all the headlines, and rightfully so. We got quite a situation going on with Iran. The conflict started right at the end of February, and it's mostly been escalating. The number one issue when it comes to Iran and what's going on with our economy, global economy, and the stock market, of course, it's mostly about the Strait or Hormuz. You see, the Strait of Hormuz has about 20 to 25% of the oil traffic that goes to the global marketplace. And it's not just oil, but in this region here, there's a lot of natural gas. There's also a lot of fertilizers that are created by using natural gas. These nitrogen fertilizers, what we use for growing crops. And so the concern is that if you have a bottleneck here, which is what's happening with the Strait of Hormuz, where now the IRGC is creating lots of havoc. People are afraid to travel through there. It's created a massive bottleneck, so there's not a lot of movement going in and out of there. And so it's making the oil prices go up considerably. We are looking at oil prices that are now in the 110 range, where before the conflict we were at about $60 to $65. So we're up about 80% in oil prices. Now, the big question is, if this goes away pretty quickly, then oil prices can resume back to normal, and this will just be kind of a blip. But unfortunately, what's happening is it's very hard to stop Iran from closing the straits, because it's not just a military job. It's actually a job where you have to give these $500 million tankers and their crew the confidence to go through there without something happening very badly to them, and of course also the insurance to pay to go through all these dangerous waters. And so it's going to take a while. I do believe the U.S. could do it, especially if they get some help from some of our allies, but it could take a while to actually open up the Strait of Hormuz by force. So if there could be a ceasefire that accompanies some sort of deal to open up the strait, that would be great. But unfortunately, I do see that the potential that we might be looking at more long-term effects from this than I was looking at about a month ago. We're seeing Iran strike its neighbors, some of their oil fields, some of their refineries, some of their storage facilities. That is not good. It takes a while for all that stuff to come back online. And so this could have effects, even if the Strait of Hormuz was opened up completely today, where it could still have effects that it would have oil prices stay kind of high for several months to come. In fact, as you can see by the oil prices right now, I said about 110. If you do look out into the future and look at the oil futures, we are seeing the prices of oil come down, but unfortunately they're not coming down very quickly. It's looking like it's going to take almost till the end of the year to get prices back close to where they were before the conflict started. So that's going to have some negative ramifications for the economy, potentially for inflation. And once you start talking about inflation, that's going to make the Fed slow down their process of maybe cutting rates, which would have been a nice little tailwind for the economy. So, and thus it's creating a little bit of a headwind, because we're potentially not going to get any more of those rate cuts anytime soon. Now, the good news is that the United States is very much less dependent on oil than we used to be back into the 70s, because the parallel that we draw to is what happened in the 70s when there was a big embargo on the oil and prices went up dramatically. Now, we are a lot less dependent on Middle Eastern oil because we actually are net exporters of oil. We produce a lot of oil. In fact, we produce more oil than any other country in the world, which is amazing. And our dependency is also lower because our economy has evolved over the years from more of a manufacturing economy to more of a service-oriented economy, which requires less energy intensity. Now, that might change over time, but we're not there yet. And so that has helped buffer a little bit of what's going on globally here in the United States. But what's happening around the world is still affecting our gas prices. I don't need to tell you. You got to get some gas now. It's like $4.10 or so. And so that's going to start to have a negative effect on the economy because for a lot of people, they have to replace things that they're buying for gas. So it's going to be a headwind to the economy. So that's something that I'm concerned about. And we'll talk a little bit more about kind of what we're doing about that in the outlook. All right, so let's step away here a little bit from all the headlines and all the hype, and let's talk a little bit more about actual historical perspectives. Okay, I looked at a couple different things. I looked at what happened in the past when we've had big geopolitical shocks. Okay, when you look at the short term, the 3 months, even the 6 months, there can be a lot of volatility, a lot of noise. There's a lot of things that we don't know. Is this going to end quickly? Is Iran going to be able to hold out much longer or not? Is there going to be a deal or not? It's hard to say. But when you start going out a year or longer, after these geopolitical shocks, oftentimes the market is up nicely, okay? And it's also important to know that going into this geopolitical shock, we're going in with a pretty healthy economy. And so that also improves the odds that we'll have a positive result a year out from this event. So it's good to look at that perspective. I also looked at the oil shocks when the oil prices went up a lot. That's also why I wanted to show you how we're not as energy dependent and Middle Eastern oil dependent as we used to, because I think those oil shocks will be a little bit more muted. But you can also see even with the oil shocks, we do typically get through those and see a much more positive outlook a year later. And I think this is what we're going to probably see here as well. I think there's going to be some lingering effects, and we're going to position ourselves for that. But for the most part, a month or maybe a little bit more later, we're going to see that things are going to start to change, and it will be probably a good buying opportunity, especially for my younger, more high-risk appetite clients, to take advantage of some much better prices for the stock market at this point. All right, so now let's talk about the Heartwood implications, kind of what it all boils down to. As you can see by the tone of my video, I'm being very cautious right now short term, which is why we're continuing to be neutral, even slightly bearish, which means that I'm going slow in implementing any new strategies or in any trades where going into stocks, taking my time, but generally still following the same rules of last month where we're adding a little bit more to international. It's nice that it's been taking a little bit of a hit, so I've been able to leg in at better prices, reducing a little bit of tech and real estate, although I might be pretty much done with that here shortly because tech is almost getting a little oversold. Reducing a little bit of bonds, adding a little bit more to commodities, taking advantage of the fact that this situation with Iran could persist, especially with the prices of oil might stay elevated, so those commodity prices might stay a little high, and so that will be a nice buffer. Plus, it's a nice insurance plan in case things get worse and not better, which I hope that doesn't happen. But if it does, we'll have a little exposure there to cushion us. But overall, the market has been holding up pretty well. And a lot of it is because of the historical context that I just showed you before. And the other part of it is because with Trump, again, he wants to move on from this pretty quickly. He's going to find an off-ramp as quickly as he can. And I think the markets are reading into that, correctly or incorrectly. They are reading into that a little bit. And so am I. So I hope this explains kind of what's going on a little bit better, gives you a little better insight. If you have any other questions or any concerns, please feel free to reach out. I'm always happy to chat, discuss anything that's on your mind. But thanks again for watching. God bless.